The financial landscape is shifting, and Goldman Sachs has just added its voice to the chorus predicting a change in the wind. In a surprising move, the venerable institution now foresees the Federal Reserve slicing interest rates as early as July 2024, a departure from their previous projection of a later date. This tweak in their outlook doesn't signify a seismic shift in ideology, but rather a recalibration of when certain economic thresholds are expected to be breached. What's triggering this adjustment is the swift descent of inflation, prompting Goldman to envision what they term as normalization cuts to bring interest rates down from a 22-year high. Now, the question that hangs in the economic air like a delicate balance is this: are we witnessing a timely correction by the Federal Reserve or a potential overreaction to favorable inflation figures? Welcome to Global Economic Drops, where we bring you simple summaries of important daily and weekly economic news from around the world. Our mission is to simplify the economy and help you navigate the treacherous waters facing investors today. So before we get into today's videos, hit that subscribe button and turn on post notifications by clicking the bell icon. And if you find our news briefs valuable, don't forget to hit the like button. Leave a comment down below telling us just what you think is going on with the state of the world, and share this video with a friend or two so that you can all stay updated together. Thanks for watching, and now let's dive into it. The shifting tides of monetary policy, Goldman's forecast, and the evolution of economic projections. Goldman Sachs, a stalwart in the financial realm, has revised its script on the Federal Reserve's next move. In a recent note, the bank's economics team, headed by Jan Hatzius, suggests a significant timeline adjustment, anticipating interest rate cuts starting in Q3 2024 instead of their previous forecast for core. The catalyst? A faster-than-expected decline in inflation, particularly in the core personal consumption expenditures index, the Fed's preferred metric. Normalization cuts and the quest for balance. Goldman characterizes these anticipated rate reductions as normalization cuts, a strategic move to bring interest rates down from what's perceived as excessively high levels. The crux lies in the belief that once the inflation hurdle is cleared, maintaining interest rates above the neutral range is unnecessary and possibly counterproductive. The dance of financial conditions and rate expectation. As the Fed gears up for its final monetary policy decision of the year, the financial arena braces for a potential recalibration. Goldman's foresight introduces the notion that the Federal Open Market Committee, FOMC, might witness a schism in its ranks. While encouraging inflation data might sway some toward advocating more cuts, others could exercise caution, wary of fueling premature market expectations. Challenges and unknowns. The delicate dance of projection. Goldman's prediction, while bold, is tinged with caution. The team acknowledges the fragility of such forecasts, recognizing that even minor fluctuations in inflation forecasts could send ripples through their projections. The intricacies of the wage growth scenario further complicate the landscape, adding a layer of uncertainty to the Federal Reserve's potential course of action.